Today, I want to show you my ultimate retirement checklist. Now, this is designed to help really anybody with their retirement planning. The checklist can really help you if you haven't started, kind of give you that roadmap, things you need to research, kind of point by point, making sure that you're covering all your bases. And if you have done a lot of work, it can be a good checkpoint to see where you're at and if you've kind of covered all the items. It's really going to just kind of give you the clarity and confidence in your retirement planning. It's going to just make sure that you've got a strong foundation. A little bit about me. My name is Caufield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. Now, let's take you through this checklist that I put together. The first section is getting an idea of your retirement vision and lifestyle. So this is kind of the soft section, but I think it is really important to think a little bit about what does your ideal retirement really look like? First of all, where are you going to live? Are you going to live in the same home? Are you going to downsize? Are you going to relocate? Are you going to be close to family, friends, community? It's not uncommon to see people here in the greater Seattle area. These snowbirds have another home down in, say, the desert or Palm Springs, or even eventually relocate someplace like that. Now, what does daily life look like? Are we talking about, is there going to be some travel? What kind of hobbies do you have? How much family time are you going to partake in? Are you going to do some part-time work, some volunteering? How are you going to really fill the time? You'll see a lot of retirees spend a lot of time on things like TV. And not that there's anything wrong with watching a little bit of TV, but I don't think it's a very fulfilling retirement to just be stuck in front of a TV 24/7. Do you and your spouse agree on your daily routines, your travel goals, your budget priorities? I think this is a surprising sticking point sometimes where one spouse is already home from work and when the other retires, it's a big adjustment. And for some people, it's pretty seamless. It's great. And others, it's like, oof, that was a little uncomfortable. We weren't really ready to be around each other all the time. We didn't quite have everything figured out. Now, kind of along with this is, are you emotionally and socially prepared for your retirement? Do you have purpose and social connection? Did you get a lot of your identity out of your work or your job or your career? How's that going to kind of transition in retirement? Just making sure that you've kind of covered all these bases. Kind of a final just vision and lifestyle point is, what is your potential longevity going to look like in retirement? Genetics do play a really large role. One of the value investors I've heard of before, his name's Irving Kahn, and I think he and almost all of his siblings lived like to 105, 110, 115. They had just fantastic longevity genetics. You just want to take that into account in your situation. So, keep those things in the back of your mind when you're doing some of the, first of all, when you're going to retire, what kind of withdrawal rate you're going to take, what your Social Security strategy is going to be. And we'll get into more of that later. But again, what's your current health? Do you have pre-existing conditions? Do you have a good or poor diet? What's your exercise habits like? Are you a smoker? Just all those kind of things that could impact these going forward. Now, let's start getting into the financial meat and potatoes here. So section 2 is determine your spending needs. One of the first things I want you to do is try to figure out what your average monthly expenses are going to be. Is that number going to change during retirement? For some people, when you're home all the time, all of a sudden you've got these early go-go years and spending can actually increase. Although I will say statistically, it does go down. Now, when trying to figure out this monthly number, just keep in mind, I do find a lot of people underestimate their actual expenses by up to about 30%. So a second thing I have people do is try to calculate your actual spending over the last 2 years. I like to have people pull a couple years of tax returns. We'll take their adjusted gross income. We'll back out the amount of taxes they actually had to pay, and that gives us an idea of their after-tax cash flow. From there, we're going to adjust it for non-repeating expenses. So, for instance, if you've got a kid in college, we won't count that as a true expense. So once we have your after-tax cash flow, we want to figure out how much did you actually save. Let's say after taxes, the after-tax cash flow was $100,000. You saved an extra, say, $10,000 into a savings account. So we would figure that your spending number is $90,000. But maybe that $90,000 included a $20,000 tuition payment that you will not be doing in the future. Kid's going to graduate college. So, okay, then we're going to adjust it and say your actual spending is $70,000. How does that compare to what you guesstimated your average monthly expenses were in the first part? So I think that's a really valuable thing, helps your planning. Once you have an idea of these monthly expenses, we want to try to begin tracking your future expenses against kind of your estimate. And this is just so huge because, there's not a lot of levers we can pull in terms of how much you've saved, especially if you're close to retirement. So expenses is the big one that we can control, but we got to get a really good idea of where we're actually at and whether that's going to be sustainable in the future. Now, the third big section after expenses is figuring out what are your income sources and gaps. So we start with Social Security. Do you know what your estimated Social Security benefits are going to be? What are they going to be at 62, your full retirement age? That's 67 for most. What are they at 70? That's when they're going to be at their full maximum amount. You can just get these from the Social Security Administration. You can go pull benefit statement. You want to, figure out, have you modeled different Social Security claiming strategies, whether it makes sense to claim early at full retirement age, to delay? Have you thought about spousal or survival benefits? Have you done some research into the internal rate of return on delaying Social Security? That's how I encourage people to think of it. If you decide to take at 70 versus 62, you're foregoing 8 years of returns. If you tragically passed at 69, you would have received no benefits in delaying. So your internal rate of return is massively negative. If you only lived to 75 and delayed, you'd only have 5 years of benefits versus having received 13 years of benefits if you took early. So there's an internal rate of return on this, and that's how I like to think of it, because the alternative for most people is pulling down on their retirement assets. So by leaving those retirement assets in investment portfolios, you want to figure out what the rate of return on delaying is. And of course, the longer you live, the higher that return goes. And it does become pretty attractive for those who are going to live into their mid to late 80s and beyond. So something to consider there. Just make sure you understand that in terms of your planning. Again, as we look at your income sources, what's your, do you have any pensions, annuities? Being able to include that and model that out for your planning. Any alternative income streams? Do you have rental income? Are you going to do some part-time work? Is there royalties? Are you going to have inheritance? Hard to maybe plan on that, but just keep it in mind. From there, we're just trying to fill in the gap. So what is the portfolio withdrawal we need to get to fund the rest of your expenses? In section 2, we were figuring out how much you need each month. Section 3, how much do you already have coming in from other sources? We kind of have a plug figure here in terms of withdrawal rate from your portfolio. What does that result in? Historically, 4% has been considered a safe withdrawal rate. So if you had $1 million portfolio, you were to take a 4% withdrawal rate, you would pull $40,000 in year one and inflation adjust that going forward. Many are comfortable with a 5% withdrawal rate under more updated investment assumptions. So kind of depends on what you're comfortable with. In today's environment, we do have pretty high starting valuations for stocks, something to keep in mind that has resulted in low safe withdrawal rates historically. Again, we're just trying to see where you're at here. And to me, this is one of the most important numbers, and making sure that you're in a good place. Those who have aggressive needs on this gap just don't feel like are in a great place for retirement. We'd really love to see that number be 4% or lower, because it's so easy to increase spending. It's really hard to cut it back. And then finally, too, is figuring out your withdrawal strategy in the future. Are you just going to inflation adjust it? Are you going to implement like a guards rail approach, some alternative withdrawal strategy? Do a lot of thinking around this, and I think you're going to be really well prepared. Now, section 4, we're talking about investments and risk. So is your current portfolio aligned with your retirement timeline, your risk tolerance, current market conditions? Oftentimes we see people just kind of on autopilot, and that's served them well in many cases, but as they enter retirement, their risk tolerance has maybe adjusted, their needs have maybe adjusted. They don't need to hit home runs. They might only need a base hit or a double in terms of their market returns. They just don't need to take too much risk. Look at your portfolio, look for opportunities. Can you improve the tax efficiency? Can you improve the fee profile? Maybe you're in some higher fee mutual funds. There might be low cost ETF type alternative. Have you thought through sequence of returns risk in your portfolio? So, one of the big risks to withdrawal rates and in retirement is a big drawdown early. So, making sure that you are set up for that, both in terms of your mental makeup to not panic and get out of stocks, but also in terms of your portfolio, that it wouldn't just get decimated in a downturn. And as part of that too, do you have an adequate emergency fund so you don't feel like you're panicked and need to pull at poor time? Now, section 5, we're into tax planning. So I'd like you to review your holdings in tax deferred accounts. So for example, IRAs, review what you have in tax-free accounts. So like a Roth IRA and a taxable account. Now, sometimes it's nice to have a little bit of a blend here. It gives you more options in terms of optimizing your overall tax situation and hopefully minimizing that in the future. But I often like to just get a pie chart and figure out, all right, we got this percent in taxable, this percent in tax deferred, this percent in tax free. And then we kind of want to map out your future taxable income. So we want to see, are there opportunities? Do you have some lower taxable income years where we could do things like Roth conversions or realizing capital gains at 0% rates or low rates? And, often this is possible if you're delaying Social Security, you don't have any RMDs, required minimum distributions, that have come into play yet. And then we can also kind of plan around your withdrawals to minimize, hopefully, your lifetime tax bill. Another thing about tax planning too, understand how your income impacts Medicare Part B, Part D. There's this income-related monthly adjustment amount called IRMA. Just make sure you're familiar with that. And, I'd always say, don't let the tax tail wag the investing dog, or in this case, the, income dog. But being aware of it and making sure that you're not missing any opportunities, I think is important. If charitable giving is part of your plan and your retirement, make sure you're aware of qualified charitable distributions. That's a great tax advantage tool for those who are charitably minded and have RMDs. And then finally, optimize your current savings. Are you in a high tax bracket now? Maybe you're in kind of your peak earning years before retirement, whereas you'll be a lower tax bracket in the future, or at least lower taxable income in the future. You might want to prioritize saving into tax deferred accounts like a traditional IRA or 401k, knowing that when you withdraw it in the future, you'll be in a lower rate. So, I often find that's the case where people just don't realize how much their taxes could potentially go down in retirement when they're no longer in peak earning years. Occasionally, you'll see the opposite though. If you're in a low tax bracket now, let's prioritize those tax-free accounts, Roth IRAs, HSA. So moving on, make sure that you just kind of have thought through healthcare and insurance. So have you planned how you're going to cover healthcare before Medicare kicks in at 65? If you are retiring before 65, you got to make sure that you've at least looked into what does marketplace insurance cost. I'll warn you, it is shockingly expensive if you haven't paid for your own before. Are you going to go the COBRA route? So stay on your own plan, but basically pay for it yourself on a gap after work before Medicare kicks in. Are you going to do part-time work and get benefits through that? But this is a huge one, especially if you're looking at retiring before 65 and Medicare comes in. Now, once you are 65, make sure you understand the way Medicare works. There's parts A, B, C, D, there's Medigap, there's Advantage. It can be pretty confusing. There's those IRMA surcharges I mentioned before. So the income-related monthly adjustment amounts. All this could just kind of make your head spin. And you also have to understand that the importance of signing up when you're 65 so that you don't get any penalties for not signing up on time. And then finally, this is just kind of make sure you've covered all your bases insurance-wise. Review all your insurance policies, whether you have life or disability, property, long-term care, and make sure you've determined which, if any, are actually needed for your situation. I recommend you evaluate self-funding long-term care. So a lot of seniors are worried about long-term care, understandably so. The out-of-pocket expenses on things like nursing homes and other facilities are very, very expensive. But what I often find is most of my clients end up being better off financially just self-funding that when you really kind of break down the cost versus benefits of it. But I recommend you kind of look at your own situation and do the math and just make sure you're conscientious about it. Same thing, life insurance, for example, of many seniors is just not usually a necessary thing unless you have a unique circumstance or you're using it as an estate planning tool. Now, finally, let's get into estate and legacy planning. Now, make sure that your estate documents are up to date. Your wills, living trusts, powers of attorney, healthcare directives. If you don't have any of this, you need to evaluate whether this is something that you do need. At the very basics, just a simple will can kind of go a long way towards making things easy on your beneficiaries. And speaking of beneficiaries, confirm your beneficiaries on all your retirement accounts and insurance policies. This is super important, especially if there's been any changes in your life or situation. And then it's really helpful if you can organize those important documents like the wills and insurance and medical directives and put them in a central location, and hopefully let somebody know where those things are at, so they know where to look for them in case, the unfortunate happens. And then also, if you've got any digital assets or online accounts and need to include those in your estate plan, it's more of a newer thing, but make sure that is in there. As part of your estate legacy planning, do you have charitable giving, legacy goals? Have you reviewed your estate planning and tax strategies with a professional? That's one of the things that, if it's been a long time or you've never done it, can be really helpful in this area, whether it's a attorney for some of your estate planning documents or just a wealth management professional like myself, to kind of just look at your overall plan and make sure that you've covered all the things that you need to cover. Here in Washington State, for example, it's important that those with reasonable assets have a will in place that allows for a trust, because you want to preserve your spousal exemption. Washington State has one of the highest estate taxes in the entire nation. And so you want to make sure you preserve both spouses' exemption. And you can only do that by either including it in the will or putting a trust ahead of time. Unlike, say, the IRS, now granted, very few are subject to estate taxes at the IRS level, but the IRS, you can fill out a simple form and that preserves both spouses' exemption. That's not true in Washington State. Okay, finally, Section 8, it's your action plans and next steps. So, review your plan with an advisor or a trusted professional. Make sure that you have covered all your bases. Again, I want you to track your spending against your budget or estimates on a go-forward basis. If you can do it at least for the next year, follow your bank accounts and credit card statements and so on and so forth carefully to see where you truly are at. And then commit to regular reviews. Schedule an annual review of your retirement plan and just make sure that everything is on track. And if it's not, make timely adjustments as your life changes, and monitor your tax planning, your portfolio performance, your withdrawal strategy. And, finally, avoid that one more year strategy. So, evaluate if work is truly continuing to improve your life or it is just your bank account. Be intentional with it. I see a lot of people who have the financial means to leave the workforce and they just kind of have this one more year. I'm going to go one more year, and they don't really need it. Now, if work brings them joy and meaning, that's fantastic, but just make sure you're doing it for the right reasons. We want you to be intentional so that you can enjoy your very best life and retirement. And, finally, you'll see just some retirement milestones and triggers there, some ages to be aware of. That is the checklist. I think if you go through all these steps, you can answer all these questions. You're confident that you've really put together a good plan with a solid withdrawal rate. I think you're going to be set up for a fantastic retirement. And that is my hope for you. So I encourage you to download this checklist, walk through it on your own or with your spouse. Make sure that you have covered all your bases. Please share this with anyone you think would benefit. I love it if you visit my website, like this video, subscribe to my channel. Thanks.